Hi, Assalamualaikum. My name is Hamam. Please, Maisa.
My name is Nur Fatina binti Muhammad Azhari.
Hi, my name is Nur Shafika binti Amran.
My name is Alianur Atira binti Ishaq.
My name is Afika Haris binti Muhammad Zarin.
Okay, today we want to present chapter 22 about audit of the capital acquisition and repayment cycle in audit 2. Okay, capital acquisition and repayment cycle concern the acquisition of capital resources through interest-bearing debt and honest equity and repayment of capital. The characteristic of the capital acquisition and repayment cycle. The first thing is few transactions affect the account balance, but each one is often highly material in amount. The exclusion of a single transaction could be material in itself. There is a legal relationship exists between the client entity and the holder of the stock, bond, or similar ownership document. There is a direct relationship exists between the interest and dividend account and debt and equity. Learning objective 1. Identify the account and the unique characteristic of the capital acquisition and repayment cycle. Okay, there is the account. This is the account in the cycle. The first is note payable. Okay, the note payable are written agreement or promissory note in which one party agrees to pay the other party a certain amount of cash. Note payable are required when a company borrow money from a bank or other lender. In the simple meaning, note payable is a loan between two parties. Okay, the information is contained in note payable is the amount has to be paid, the interest rate, the maturity date, the name of the maker of the note, which is the payer, the name of the payee, okay, the signature of the person who issue the note. Okay, the second is mortgage payable. A mortgage payable is a liability of a property owner to pay a loan that is secured by property. From the perspective of the borrower, the mortgage is considered long-term liability. Any portion of the debt that is payable within the next 12 months is classified as a short-term liability. Bond payable. Bond payable are form of long-term debt usually issued by corporation, hospital, and government. The issue of bond make a formal promise or agreement to pay interest usually every 6 months, which is semi-annually, and to pay the principal or maturity amount at a specific date some years in future. Okay, number 4 is interest expense. Interest expense is the cost of borrowing money during a specific period of time. Okay, interest expense is occurring daily, but interest is likely to be paid monthly, quarterly, semi-annually, or annually. Okay, accrued interest. Accrued interest is the amount of loan interest that has already occurred but has not yet been paid by a borrower. Okay, number 6 is appropriation of retained earning. Appropriation of retained earning is the part of the retained earning that have been approved by the board of directors for specific purpose, including research and development, stock repurchase, and reduction of debt. Okay, number 7 is treasury stock. The treasury stock is the stock repurchased by the issuer and intend for retirement or resale to the public. The next is dividend declare. Okay, the dividend declare is a dividend authorized by a company's board of director, which is the BOD. Okay, at the time a dividend is declared, the firm create a liability for the dividend payment. Number 9 is cash in the bank. Cash in the bank is the cash that has in the bank. Number 10 is ordinary share. Okay, ordinary share are share in the company that are owned by people who have a right to vote at the company's meeting and to receive company's profit after the holder of preference share have been paid. The preference share is also called preferred stock. Okay, the preference share are share of a company stock with dividends that are paid out to the shareholder before common stock dividend are issued. Okay, the next number 12 is premium share. A company issue its share at a premium when the price at which it sells the share is higher than their par value. For the example, ABC company sell a share of a common stock to investor Rm 10 ringgit. Okay, the stock has a par value 1 ringgit. Then it has issued the share at premium is 9 ringgit. Okay, next is donated capital. Okay, donated capital is asset given to entity as a gift. This is amount is recorded at its fair value as of the date when the gift was received. Okay, for the example, a manufacturing company received parcel of land as a gift from a local community when the business agrees to construct a facility at there. Okay, number 14 is retaining. Retaining is the amount of net income left over for the business after it has paid out dividend to its shareholder. Okay, the dividend payable are dividend that company's BOD has declared to be payable to its shareholder. Until such time as the company actually pays the shareholder, the cash amount of the dividend is recorded within a dividend payable account as a current liability. Okay, the last one is proprietorship and partnership capital account. A capital account is used by sole proprietorship and partnership to track the net investment balance of their owner. The owner, which is the shareholder, from the perspective of the business. Okay, the balance in a capital account is usually a credit balance. The amount of losses and draws can sometimes shift the balance into debt territory. Okay, it is usually only possible for the account to have a debt balance if an entity has received debt funding to offset the loss of capital. Okay, in a partnership situation, a separate capital account is maintained for each of the partner. Alright, next slide, I give to Fatina.
Okay, for the next slide is methodology for designing test of balance for not payable. Okay, the methodology for designing the test of balance for not payable is actually same as other account, but the difference is when determine the test of detailed balance for not payable, the auditor consider business risk, tolerable misstatement, inherent risk, control risk, the result of test of control, and substantive test of transaction, and the last one is the result of analytical procedure. Okay, there is 3 phases in designing test of balance for not payable. The first phase consists of 3, which is the first one is identify client business risk affecting notes payable. The second one is set tolerable misstatement and assess inherent risk for not payable. Auditor usually set tolerable misstatement at a low level because it is usually possible to completely audit the account balance and transaction related to notes payable account balance. And other than that, inherent risk also set at low level because the correct account value is usually easy to control. Okay, the last one is assess control risk for not payable. Okay, for the second phase is design and perform test of control and substantive test of transaction for capital acquisition and repayment cycle. For this phase, it is representative account that are significant part of the cycle for a typical business. And the last phase is design and perform analytical procedure for not payable, and design test of detail of not payable to satisfy balance related audit objective. In example, audit procedure, sample size, item to select and timing. Okay. Learning objective 2, which is design and perform audit test of not payable and related account and transaction. Okay, not payable. Not payable is a legal obligation to a creditor which may be unsecured or secured by asset, and mostly notes are issued for a period between 1 month and 1 year, but longer term notes exist. Okay, the next is objective of the audit of not payable. There are three. The first one is internal control are adequate. The second one is transaction are properly authorized and recorded with 6 transaction related audit objective. Okay, the 6 transaction related audit objective is the first one is existent, which is recorded transaction exists. Second one is completeness, existing transaction are recorded. Yang third one is accuracy, the recorded transaction are stated at the correct amount. Next one is classification, which is transaction are properly classified. And then timing, transaction are recorded on the correct date. And the last one is posting and summarization, which is recorded transaction are properly included in master file and correctly summarized. Okay, the next slide is notes payable and the related interest account. This figure shows the account used for note payable and related interest. Auditor mostly include test of principal and interest payment as a part of the audit of the acquisition and payment cycle. Because the payment are recorded in the cash disbursement journal. Okay, then internal control. There are 4 important control over note payable. The first one is proper authorization for the issue of new notes, which is responsibility for the issuance of new notes should be given to the BOD, Board of Director, or high level management. The second one is adequate control over the repayment of principal and interest. The periodic payment of interest and principal should be subject to the control in the acquisition and payment cycle. The third one is proper document and records. This includes subsidiary records and control over blank and paid note by an authorized person. Paid note should be cancelled and returned under the custody of an authorized official. And the last one is periodic independent verification, which is the details not record should be reconciled with general ledger and compare with the notes holder record. Okay, I will pass the next slide to Syafiqah Amran.
Okay, moving on the test of control and substantive test of transaction. This is because test of the notes payable transaction involve the issue of notes and the repayment of principal and interest. Okay, and then the auditor should verify recorded notes payment transaction are actually received or not, and then existing note payable transaction are recorded or not. And then recorded notes payable transaction are accurate, notes payable transaction are correctly classified, and the last one is notes payable transaction are recorded on the correct dates. Okay, and then analytical procedure for notes payable, as we learned before. Analytical procedure is the study of relationship or data between various figures. For example, we do comparison, and then we compare the ratio, the analysis and so on. Okay, for notes payable, the first one is we do recalculate approximate interest expenses on the basis of average interest rate and overall monthly notes payable. So the possible misstatement might be misstatement of interest expenses and accurate interest or omission of the notes payable. Okay, and then the next one is compare individual notes outstanding with those of prior year. The possible misstatement is might be omission or misstatement of a notes payable. And then the last one, we compare total balance of notes payable, interest expenses and accurate interest with prior year balance. So the possible misstatement might be misstatement of interest expenses and accurate interest on notes payable. Okay, and then we have two most important audit objective, which is completeness and accuracy. Okay, for completeness, we wanted to know the existing notes payable are included or not. And then for accuracy, whether the notes payable in the schedule are accurately recorded or not. Okay, and then for types of audit tests for capital acquisition and repayment, you guys can check on page 682, figure 22, 2. Okay, that's all. So I'm gonna pass on at my group mates, Alia.
Okay, moving on to learning objective 3. Identify the primary concern in the audit of honest equity transaction. Okay, there is an important difference in the audit of honest equity between a publicly held corporation and a closely held corporation. For publicly held corporation, it is more complex and need to verify three things, which is capital and common stock, additional paid in capital in excess of par, and retained earnings and related dividends. Basically, publicly held corporation is more have more transaction, and then closely held corporation. Most closely held corporation have few shareholders and only occasional stockholders equity transaction. So there's not a lot of transaction in the equity section, especially in common stock. Next is figure 22-3 shows honest equity and dividend account. So this is the T account when company issues goods and pay dividend. Next slide is internal control. We have three internal control, which is first, proper authorization of transaction. Okay, proper authorization of transaction is because honest equity transaction is typically material. The following types of honest equity transaction usually require specific authorization. First, issuance of capital stock. Second, repurchase of capital stock, and third, declaration of dividend. Issuance of capital stock, the authorization includes the types of equity to issue, such as preferred or common stock, number of shares to issue, par value of the stock, privilege condition for any stock other than common, and date of the issue. For repurchase of capital stock, the repurchase of common or preferred share, the timing of the repurchase and the amount to pay for the shares should all be approved by the board of directors. And lastly is declaration of dividend. The board of directors must authorize the form of the dividend, such as cash or stock, the amount of the dividend per share, and the record and payment dates of dividend. These three specific authorizations need to get approved by board of directors, and auditor is easy to audit this account because they just need to review the minute of the board of director to see what they decided to do. Next, internal control is proper record keeping and segregation of duties. When a company maintains its own record of stock transaction and outstanding stock, the internal control must be adequate to ensure that actual owners of the stock are recognized in the corporate records. The correct amount of dividend is paid to the stockholders, owning the stock as of the dividend record date. Record date here have 3 dates, which is date of declaration, date of records, and date of payment. And last, the potential for misappropriation of assets is minimized. Okay, in proper record keeping and segregation of duties, there is 2 important things, which is capital stock certificate record and shareholders capital stock master file. For capital stock certificate record, if the company buy back the stock, they will remove it from the record. So this is how they make sure the actual owner is on the book. For shareholders capital stock master, it is the record of the outstanding share at any given time. The master file acts as a check on the accuracy of the capital stock certificate record and the common stock balance in the general ledger. It is also used as the basis of the payment of dividend. So basically, shareholder capital stock master file is how we make sure owners are on the date of records, and it is important to keep track on this master file. And last internal control is independent registrar and stock transfer agent. Okay. Any company with stock listed on a securities exchange is required to engage an independent registrar as a control to prevent the improper issue of stock certificate. Securities exchange here means publicly traded versus private traded. For if it means public, it's required to engage an independent registrar as a control to prevent the improper issuing of stock certificate. And if it's private traded, it is kind of easier to audit because some company devoted for this process is taking care for this. For next slide. Okay. Shareholder capital share master file, the record of the outstanding share at any given time. Capital share master file record the issuance and repurchase of capital share for the life of the corporation. Large corporation, they use stock transportation, and when one person buys and sells their stock to another person, they will use service of stock transfer agent rather than the company keep tracks on this. And they also use the transfer agent to handle the cash dividend. So it's easy for auditor because the company independent from company that auditing. That's all. I'm going to pass next slide to my groupmate.
Okay, so for learning objective 4, design and perform test of control, subjective test of transaction, and test of detail of balance for capital stock and retained earning. For audit of capital stock and share premium, audit of capital stock and paid in capital. Auditors have 4 main concerns in auditing capital stock and paying capital in excess par, which is completeness, occurrence and accuracy, presentation and disclosure. Completeness, existing capital stock transactions are recorded. Occurrence and accuracy, recorded capital stock transactions occurred and are accurately recorded. For accuracy, capital stock is accurately recorded, and for presentation and disclosure, capital stock is properly presented and disclosed. So for audit dividends, occurrence, auditor can verify the occurrence of recorded dividend by examining the minutes of board of director meeting for authorization. Recorded dividends occurred, dividends are paid to stockholders. So these both are two objectives under occurrence. For completeness, existing dividend are recorded and dividend payable are recorded. And for accuracy, the accuracy of a dividend declaration can be audited by recalculating the amount of the basis of dividend per share times the number of shares outstanding. So for accuracy, dividend are accurately recorded, dividend payable are accurately recorded. So test of dividend payable should be done in conjunction with declared dividend. Any unpaid dividend should be included as liability. So for audit in retained earning, the only transaction involving retained earning are net earning for the year and dividend declared. Other changes in retained earning may include correction of prior, which is period earning, prior period adjustment, or credit directly to retained earning, the setting up or elimination of appropriation of retained earning. To begin the audit of retained earning, auditor first analyze retained earning for the entire year. To accomplish the audit of the credit retained earning for the net income for the year, auditor simply brace the entry in retained earning for net income for the year. This procedure must take place fairly late in the audit after all adjusting entailers affecting net earning have been completed. So after the auditor is satisfied, the next step is to decide whether they were accurately recorded. And lastly, auditor must also evaluate whether any transaction should have been included or not. So for the conclusion for this topic, this chapter is about the audit of the capital acquisition and repayment cycle, which is include the primary sources of financing for most business. The approach to auditing this cycle was illustrated for notes payable, related interest expense, and occurred interest for owner equity and related for related account. So that's all for today. Thank you.